Welcome to our annual State of the Markets presentation. We're happy to have all of you on this webinar today and look forward to sharing some important information with you. We have a number of our clients online, including and also myself and Glenn Michael. I will be giving the presentation today, and I promise to keep it as short as possible, and also feel free to ask questions by posting a question on the Cisco WebEx system, okay? And we'll try to answer those as we go along. So remember, if you have any questions, please don't hesitate. We're here to answer any and all that we can, so please feel free to do so. I'd like to draw your attention to these disclosures. Please take a few moments to review it. If you obviously have any questions, let us know, but these are required by our legal team. So the financial world today has become incredibly complex. These days, obviously, we're bombarded with dramatic headlines and many contrasting opinions depending on which news outlet you're watching.
Hi.
Today, we want to clue you in on some of the data we're watching. Of course, we can't cover everything, but we're going to try and touch on the most relevant factors. While past performance does not guarantee future results, we'll focus on trends that may help give a clearer picture of where we are and where we're headed. Here's what we're going to talk about today. Let's start off today's presentation by putting last year's market performance into perspective. At the end of 2019, many analysts remain close with their estimates of where the S&P 500 ended last year. Overall, the Wall Street firms had a good year with their forecasts. Morgan Stanley and Bank of America were the slightly pessimistic ones, but generally speaking, most major market strategists were largely on target with their 2019 calls. Today, we're going to take a look at what happened in 2019 and what 2020 may hold. While stocks had a solid 2019, it's important to remember that these gains were followed by a sharp decline in value during the fourth quarter of 2018. Nevertheless, it was a rewarding year for investors. We saw four primary drivers of 2019 stock market performance: monetary easing, trade, corporate earnings, and the economy. In the following slides, we'll discuss each factor separately and in more detail. First, though, let's look at how these factors affected the stocks over the course of the year. Stocks started the year on a strong note and continued to move higher. The S&P 500's ascent, however, was not uninterrupted. At times, flaring trade tensions and poor economic numbers caused investors to lighten up on stocks, sending prices lower. As you can see from the chart, stocks mostly moved higher, though, with the exception of two pronounced dips, one in May and the other in August. And you'll notice we've color-coded our four market drivers, identifying dates where each of these factors moved the market significantly. The S&P 500 is an unmanaged index that is generally considered representative of the U.S. stock market. Keep in mind, however, that past performance does not guarantee future results. Individuals themselves cannot invest directly in the index, and that's important to understand. The return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than their original cost. So on the monetary easing side, January 4th, Fed Chairman Jerome Powell hints that further rate hikes might be on a pause. As many of you may recall, it was a succession of rate hikes in 2018 that worried investors. Those concerns contributed to the sell-off that we saw late in 2018. January 30th, the Fed signals patience in rate policies, a stronger statement that further rate hikes are unlikely. And then by June 4th, Powell signaled that he's open to easing monetary policies to address the economic slowdown and trade concerns. By July 31st, the Fed started cutting implementing its first rate cuts of 0.25%, but it was expressing caution on any further rate cuts. Then they cut again in September 18th, another 25 basis points, and then on October 31st, they had their third and final quarter-point rate cut for 2019. On the trade side, January 3rd, Apple announced weaknesses in its China sales, highlighting the earnings impact of ongoing trade tensions. By the end of January, China announced intention to increase imports of American goods, raising some hopes of an eventual trade resolution. By February 15th, improving trade sentiment following President Xi's comments that negotiations would continue. We saw that improvement there. Then on May 7th, U.S. trade negotiator Robert Lighthizer makes comments on the economic harm that accompanies trade wars, following an earlier tweet by President Trump, which announced additional trade tariffs on China imports. Then later in May, Trump threatens a 5% across-the-board tariff on Mexican imports. August 5th, China's currency falls to a 10-year low versus the dollar following President Xi's announcement of tariffs, sparking fears of escalation in trade tensions. Again in August, Trump avows new tariffs on China coming as early as September 1st. And then finally in October, just to close the drama out, Trump announces a phase one agreement in principle with China, easing a lot of these trade tensions. And then on December 13th, the phase one deal agreement is signed to begin a easing of trade tensions. On the economy side, we saw some key events happen. On August 14th, a combination of negative global economic reports and the inversion of the yield curve, that's the inversion of the 2-year versus 10-year Treasury yield spread going negative, which sharpened anxieties about the health of the U.S. and overseas economies. Following that, in October, weak ISM manufacturing data indicated that September was the worst month for manufacturing in a decade. Manufacturing contracts greater than estimated coming in at levels indicates it is recession, and this was noted on December 2nd. Then on December 6th, we have a blowout employment report as 266,000 jobs were added in November, providing investors with confidence that at least the U.S. economy was healthy. On the corporate earnings side, November 11th, markets rallying to new highs indicate that investors believe that 2019 sluggish year for corporate earnings will make for easy comparable figures in 2020 if the U.S.-China trade dispute is resolved. So, in fact, we did see that, and so investors got really bullish. On the monetary side, 2019 Fed chairman recognized that business and economic conditions were slowing. So the second half of the year, the Fed implemented 3 rate cuts that we already gone over. So this kind of communication from the Fed was really important in easing tensions in addition to the actual rate cuts that we saw. This change in monetary policy was cheered by investors, sending stocks higher and yields lower. So if you remember, the Federal Reserve spent 2018 pursuing a policy of monetary normalization, which meant raising rates gradually. So as raising the federal funds and reducing the Fed's balance sheet, fears of higher rates hampering economic growth was one of the reasons for the sudden drop in stock prices during the fourth quarter of 2018. The trade side, trade obviously was a dominant market theme throughout 2019. While trade tensions with China were center stage, trade tensions with Mexico and Europe also flared up at various times throughout the year. Markets moved up and down in response to all this trade news. With the passage of the U.S.-Mexico-Canada agreement and the announcement of phase one agreement in China, the trade tensions definitely eased off at the latter part of the year. The trade will likely remain at center stage in 2020. After decades of expanding global trade, the viewpoint of the current administration is that open trade has not always been fair and beneficial to American workers. Balanced playing field, Trump has sought to reset the trade agreements and practice we have with many other nations, and not just China. Investors should expect trade headline news to remain a dominant theme throughout 2020. They should also understand that China is not the only source of trade tensions. It exists with our allies in Western Europe and countries in South America as well. That said, it's important to recognize that exports make up just less than 12% of the United States gross domestic product. That statistic may be one reason, despite all the hyperbole about trade tensions leading to a recession and a falling stock market, neither materialized. The U.S. economy, in the end, is partially insulated from the effects of slowing global trade. On the corporate earnings side, with slowing economic growth, the prospect for corporate profits was not bright in 2019. In fact, Wall Street analysts cut 2019 earning estimates multiple times throughout the year. With expectations set so low for corporate earnings, some companies surprised investors with better than expected numbers throughout the year. Overall, earnings were not strong, but the fact that they were better than feared lifted investor sentiment. You can see from this chart, if you look at the 4 quarters, uh, uh, revenue growth was positive, but net income and earnings were actually negative during 2019. If you look at the overall year-on-year growth rates, you'll see that they sharply decelerated from the fourth quarter of 2018 through the third quarter of 2019. Fourth quarter earnings actually won't start reporting until mid to late January, so we still have just estimates for that quarter. On the chart, you can also see that forecasts are trending higher in 2020 and into 2021. Many analysts had anticipated a deceleration, but thought it would be a lot worse. In fact, some predicted an earnings recession, which is defined as 2 consecutive quarters of negative earnings growth. On the economy, entering the year, the outlook for economic growth was pretty muted. In 2018, economic slowdowns in Europe and China were exacerbated by mounting tariffs and ongoing trade tensions. Economic growth during 2019 did slow from its pace during the previous year, but it stayed within the 2 to 2.5% growth rate pace of the prior decade. Slow and steady growth, a strong labor market, and low inflation proved supportive of stock prices. Consumer confidence continued to rise in 2019. Less confident were corporate CEOs. Buffeted by uncertainty stemming from ongoing trade tensions, companies were reluctant to invest. So while the consumer prospered, the manufacturing sector posted 2 quarters of negative growth before seeing improvement during the third quarter. So where are we now? We've looked at some of the factors affecting market performance in 2019. Of course, that's now history. What we're really interested in is where we're going forward. So let's examine the headwinds and tailwinds that could affect the direction of the economic growth and financial markets in the year ahead. Entering 2019, our economy looked much stronger. As you can see, only 2 measures were in the danger zone: geopolitical risks and political environment. While there were some caution lights, specifically monetary policy, international economic conditions, and housing, the majority of economic signals were positive. So just as an explanation, green is good, yellow is caution, and red is obviously things are not going so well. So, by the way, these are all just sort of indicators. They don't necessarily have a 100% predictive nature, but it's important to understand how these things work in terms of when things get better, they get green, and when that particular indicator goes bad, it gets red. So that's how we like to depict this. So as we ended the year, a number of indicators, the number of red indicators basically stayed the same. We're still the political and environment and geopolitical risk. However, we see more indicators flashing yellow than we did at the start of the year. Among these were the overall U.S. economic outlook, corporate profits, and equity valuations. As you can see there, you can see that the corporate profit growth is yellow, business outlook is yellow. And it's important to understand these signals in the context of what we just explained that happened in 2019. Business uncertainty, trade tensions, and things like that. Some of these background issues have eased. And so while these corporate profit growth and business outlook are flashing yellow, there is a possibility that these could improve. Now, we can't predict the future, and financial markets don't always act in concert with the economy. That's really important to understand. Barring some unexpected shocks, the U.S. economy appears to have room for continued growth for 2020, and that's a very positive thing. So let's delve a little deeper into one area of these phenomena. The leading economic index is the LEI. This measurement includes 10 components ranging from stock prices to manufacturing orders. Examined together, the data may give a clearer, less volatile view of where we are. The latest report shows continuing modest growth, suggesting that economic growth may continue in 2020. As you can see in this chart, recessions have never started when the LEI is increasing. It's important to remind people that past performance obviously doesn't guarantee anything for the future, but as we reviewed the charts, like the leading economic indicators, history can help us suggest where we are in the economic cycle. And so while the economic cycle seems a little bit long in the tooth, the growth is still moderate and the conditions are still overall somewhat favorable. So we just saw from the LEI and the economic speedometers that the economic outlook remains positive, though perhaps not overwhelmingly so. We see several headwinds that could be a problem in the year ahead. Business cycle, slowing global growth, which there's some indication. Obviously, trade policy could still be a concern, maybe less so with China, but definitely some issues with Europe. Maybe some higher volatility in asset pricing, like the stock market. And then the big one, the 2020 elections, which, although a lot of people will think that that's an important indicator for how the stock market is going to perform, generally elections themselves aren't the issue. It's really the policies that are being pursued in those elections that people are paying attention to. I always like to encourage our clients that when it comes to elections and economic policy, it takes many, many years for economic policy to feed its way into the real economy. So even though you hear different economic policies being proposed now, either by Trump, the incumbent, or whoever the challenger might be, we need to understand that those economic policies will take years and years and years to be implemented, and that's how slow government policy moves. Obviously, the acceleration of wages, that can be a good or bad trend. It's tough on businesses, but it's actually good for overall spending. So that's probably one of the reasons why consumer sentiment is so high. Okay, moving on to the tailwinds. We also believe that there are a number of tailwinds that could continue to support economic growth. While the pace may be moderate, there remain indications that this economic expansion may continue. 2 points to make on these tailwinds. While the Fed has indicated it may pause on further rate cuts, the effects of the rate cuts in 2019 may take up to 6 months or more to take hold of the general economy. This gets back to my comment about policy. The lower rates definitely will help ease financial growth by making costs of financing and things like that cheaper, and that's a real positive. It's also a real positive for the housing market. The other thing to point out is corporate profits. Corporate earnings growth had a high hurdle to clear in 2019 as they were being compared with 2018 earnings, which had been fueled by a large corporate tax cut. So that tax cut really had increased the corporate earnings for 2018, which made the comps for 2019 really terrible. That one-off fiscal injection is going to fade out in the comps, and so we should see going forward some positive growth on that on the corporate earnings front. So just wanted to make that clear. So let's examine this chart to see whether stocks are at fair value or not. Obviously, that's going to be on the minds of many different people. The most common way to look at pricing of the stock market is to look at the PE, or the price earnings ratio, which is a measure of what investors are willing to pay. I mean, how many dollars they're willing to pay for a dollar of the company's earnings. So it's a ratio. The higher that PE, the more expensive stocks are deemed to be, meaning people are willing to pay more for the same amount of earnings. That would be what we call a valuation increase, meaning the valuation of the overall pricing increase, even though earnings may not have. If you look at the dotted line in the middle, you can see that the PE for the last 25 years is on average 16.22. You can also see that the PE moves around quite a bit, with a peak during the dot-com boom and a trough during the Great Recession. As of September 2019, the PE is 16.82, which is close to the 25-year average. By the way, we say September because the full earnings report for the fourth quarter not quite out yet for some companies. So if the PE, think about this for a second. If the PE ratio remains the same, meaning people are going to pay the same amount per dollar of earnings, and the earnings are going up, all things being equal, we should expect a positive return. So obviously, if people are still going to just pay 16.82 for their earnings, which they were paying back in September, they pay it today. If corporate profit goes up 5%, all things being equal, we'd expect a market return of 5%. Now, obviously, other factors change, so we can't say all things will be equal. It's possible something might affect the market outlook. But as it stands, a positive corporate earnings growth rate should drive values nominally higher. We talked a lot about what impacted markets over 2019 and what may impact markets in 2020. So let's see what the experts actually have to say about this and where they think the market is headed. On the inflation front, inflation is obviously an important economic indicator. Rising prices impact the entire economy. Too much inflation can obviously hinder growth, while too little can actually cause issues as well, which they call deflation. Inflation is also one of the key indicators that the Fed uses in determining the level of interest rates. Currently, inflation is close to the Fed's target rate of 2%. They have said that absent of persistent above target inflation, they don't foresee raising short-term interest rates anytime soon. There are some inflationary pressures, a little bit, rising labor costs chief among them. But the long-term trend suggests the Fed is managing inflation pretty well. This is a chart that we've actually shown before. Just to remember, rates were cut 25 basis points 3 separate times over 2019. And basis points, by the way, is 0.25% or a quarter of a percent. As mentioned in the previous slide, the Fed does not currently envision raising rates in 2020 unless inflation breaks sharply above its target rate and stays there for an extended period of time. So let's take a look at this chart. The red dotted line represents a 5% yield on the 10-year Treasury note. The teal diamonds represent stock returns. The chart shows when yields are below 5%, which they are now, stocks have tended to rise in concert with rate increases. And the main reason for that is the rising rates indicate a growing and expanding economy. And that's generally positive for companies because their earnings will grow in line with that. Again, we don't expect any rate increases this year, but should yields rise sharply, stock prices could potentially come under pressure. But I think that it would be definitely a significant outlier event. I don't think we have the economic growth to warrant such a rate increase. So generally speaking, even if rates do rise a little bit in the year, we should be interpreting that as generally a positive thing going forward. So U.S. economic growth slowed during 2019, is expected to slow further in 2020, as you can see here from the projections. However, a positive real gross domestic product suggests that a recession may not happen during the year. And a quick note when we talk about recession, and I always try to emphasize this with our clients, economic recessions are not the same as market corrections. Economic recessions refer to overall economic growth, and a recession is when we have 3 negative quarters of growth. That's generally the definition that they use for a recession. That's growth of GDP, negative growth in GDP. A market correction, of course, can happen whether the economy is growing or not growing. It all depends on market sentiment at the time, and we'll get into that a little bit later. The unemployment rate is expected to close out the year at 3.6%. Strong employment growth and the deceleration layoffs contribute to a historically healthy labor market, which continues to be so. Robust employment and higher earnings make for a healthy consumer, which is a good sign for economic expansion. And right now, consumer sentiment is really strong. At times, low employment has indicated the end of the cyclical expansion phase, though it's tough to see where that inflection point might be. So what are the experts forecasting for domestic equities in 2020? Overall, they are suggesting a modest gain. A couple of analysts are calling for a flat to down year, but most see a moderate move higher. Some are a bit higher in the 5-6% range. Some are as low as 2%, but we'll see. And so basically, in large part, that's probably based upon expectations that investors are not going to pay higher valuations for the same earnings. So all things being equal, we should see growth in line with corporate earnings. Of course, we don't really know for sure what equities will do in 2020. That's an important thing to understand. And predictions at this stage are just that. They're just predictions. However, these analysts' perspectives show that for the most part, Wall Street remains fairly cautious and optimistic about 2020. So we've covered a lot of information today. If there's one takeaway here is that the path the market takes is never a straight one. Even in a good year, the S&P 500 can suffer substantial declines. But for the patient long-term investors, stocks shown themselves to be an excellent means for growing wealth, and helping pursue financial objectives. So one thing I wanted to point out about this chart is that it shows like the intra-year decline. The average intra-year drop is about 14%. That means from peak to trough in any given year, the S&P 500, which is a proxy for large cap U.S. companies, on the average year, we'll see a 14% decline from peak to trough. And what does that mean for us? That means even in your average year, and if your average year is yielding a 9 to 10% return, depending on what kind of time segment you're looking at, but even in an average year, you have to go through a 14% differential in your stock pricing in order to get the 10% return. This is something that Glenn and I constantly try to remind our clients, is that in order to get the average return, you have to go through the average volatility, and that volatility is 14%. So nonetheless, markets still grow, wealth still creates, and it's important to stay the course, especially when it comes to market movements and fluctuations. It's a common theme you hear from us, and it's one that we continue to abide by. The main lesson here: investors can harm themselves when they react to short-term market drops, right? In our view, the best decision for you as an investor is to pursue your long-term goals based upon your time horizon and your risk tolerance. And by risk tolerance, we mean how much risk are you willing to accept in order to capture those long-term gains? And that's something that is not on average to everybody the same. It's particular to each person. It's why we ask each of you to go through risk tolerance questionnaires and update that periodically, so that we understand that we're all on the same page in terms of how much risk you're willing to get or to accept in order to get the returns that you need for your financial plan. So some of the things that you can do in 2020 to move towards your goals. Here's some action items. So if your life or personal situation changes, please keep us in the loop. It's important for us to understand what's going on. We want to hear about important family events like births and deaths. We also care about health issues, employment changes, and any financial developments like an inheritance that may change your situation. And if you find yourself thinking about new goals or reevaluating your priorities, share your thoughts with us so we can help you pursue life you most desire. And that's really an important point, especially when we do our financial planning using our eMoney software, which so many of you have taken advantage of. On top of specific adjustments in your financial life, we also want to know how you feel about investing changes. These could be details like a shift in your risk tolerance or any concerns that you might have about the market environment. We try to keep you abreast, but if you feel like you need to have a conversation about what's going on, please feel free to contact Glenn or I. We'll have a conversation with you about it, and we'll give you our views. Finally, remember to go over your estate documents, beneficiary designations, and other paperwork to make sure you're all up to date. A well-organized estate is one of the best gifts you can give to your family. We're here to talk you through whatever financial questions, worries, or excitement you may have. Our priority is always to help you make informed decisions and stay on track. Throughout 2020, we will focus on delivering the following action steps for you. Keep you informed through regular communication. You hopefully are getting our emails and other documents that we send out, information that we send out to keep you apprised of our view of the markets and the financial situation. Manage your investments according to your personalized strategy. Each one of you have had numerous discussions with us. We have a good and intimate knowledge of your situation, and we have a good feeling about how your portfolio needs to be positioned. Finally, we'll stay on top of changes in the market environment and make prudent adjustments where necessary. We do regular rebalancing of our portfolios to keep them in line with the risk profile and the trajectory of what they're supposed to be doing for you. So please understand that we're constantly on that and constantly reviewing the investments to make sure they're the most optimal investments for you. So we've gone through a lot of information here, and I'm sure you probably have some lingering questions. Now would be a great time to pose those questions. So we're going to stay on for a couple of minutes to see if you have any questions about any specific slides or specific information that we've gone over today. You can do that by posing a question on the WebEx platform. Let me just take a quick look to see if you guys have any. So there's no questions at this point. If you have any personal questions that you have regarding your personal situation, I'd be happy to field a call. Give us a call. Let us know what's on your mind. Glenn and I are very passionate about helping you understand the markets and find important facts amidst all the hype that's out there. There's definitely a lot of it. Please follow us on our social media account. We have a Twitter account. We have a Facebook account. Follow those. We'll send updates. Oh, we do have one question. Okay. We have one from Charles. Charles, what's the question that you have? You can put that in the chat. You see that? Where's we have a slight technical issue here. System. Let's go. Okay. Okay, we have the question is, how's the current condition of the coronavirus impacting your 2020 forecast of the economy? That's a very good question because that's a situation that is in flux. If you've been following the news, the numbers of impacted people in China have been greatly raised. The number of cases, say, is increasing. There's definitely going to be an impact on the global growth rate, and the estimates I've seen are like quarter to 30 basis points on global growth. So if global growth is 2.8 or whatever globally, they're expecting that to have a hit in the first part of this year. I've read different reports on this, and I've also read a number of analyses, economic analyses. The impact seems to be muted when you look at historical examples like the SARS virus, et cetera, and things like that. So I think you're going to see some downward revisions of global growth. based upon that. So, and I think that you've seen some of the market tensions based upon that, but then um, it's for usually we have a recovery within, I don't know, 2 to 3 quarters back to normalization. So another question: can you explain the inverted yield curve and why some analysts are concerned about it? So the inverted yield curve is when the 2-year rate on the Treasury, the 2-year Treasury, goes higher than the 10-year Treasury. So say that the 10-year is at 1.5 and the 2-year is at 1.7. Ordinarily, the yield curve is steep, which is rising because you have to pay investors more to hold longer term bonds. When that inverts, it means people are selling longer term. They're not. Let's put it this way: they are not comfortable with the long term growth impacts, so they're going to safety and buying short term treasuries. So this has the impact of the bigger impact is really just a nominal one in the sense that it has been a weak predictor of recessions. And I say weak because we've had inversions before and they seem to have been head fakes, where people are cautious, but they didn't actually turn out to prove correct. So that's the importance of the inverted yield curve. And we had it briefly, and then it went away, and we're still not at inversion. If we were to see that again, and that inversion persisted for any length of time, it could be an indication that there are some recessionary pressures, and maybe that could be due to the virus. Though I think that's going to be a short-lived impact. So hopefully that's explained the concern about the yield curve. It's really as a predictor of a recession, which I feel has, from all things I've read, it's not been a strong predictor, sort of a weak predictor. And I think that some analysts are concerned about that when they see it. Do we have any other questions? Well, if I don't see any pop up on the chat, I hope you enjoyed the information and the details we've shared with you today. You've definitely brought a couple of good questions to us. At the end of the day, investing is long term, and it's important to understand that. And generally speaking, we can. Oh, what do you think? Okay, there is a new question. Who do you think will win the election? How would that affect the markets? I'm not a political analyst, but I can say that an incumbent president in a strong or at least growing economy almost never loses. So if I had to, that's a very strong predictor. So all things being equal, if the economy continues to grow, even if it's mildly, and consumer sentiment is high, et cetera, I think it's going to be a re-election for Trump. I think that markets are generally view Trump as favorable. So I think that the sentiment will continue to be positive. There is maybe a general understanding that a Democratic president, especially of the Bernie Sanders, Elizabeth Warren types, that it's bad for the economy. Having said that, there was an article out in Bloomberg today why a Bernie Sanders presidency would not be bad for investments. So my thought of that, we try to stay neutral on these because our feeling is that presidencies and administrations don't actually have long-term influences in terms of their policy announcements and things like that. It's really what happens on the broader governmental side. You can have a president saying one thing, but if the other party controls the Congress, you're not getting much done. So that's, I think, the issue. So it's really, you have to look at the big picture. Right now, it seems that the direction that has been set by the Trump administration is really a continuation of concerns that have been lingering for a long time regarding the trade front, jobs in America, et cetera, all those things that are on his platform. Those have been concerns for a long time. He's probably done a better job at voicing those. But what we're seeing now is long-term trends. I think one of the biggest things that you could expect from a Democratic side, especially if they can control the Congress, which would be positive, would be infrastructure spending, which would be a big fiscal policy move and could have long-term impacts for growth in the country. But again, we have to look at these as the long term. Long term is it's much harder to predict how policies will have the effect. What I can say is short term, even if markets did react negatively to a Democratic win, I think that would be somewhat muted. I think that would get washed out as noise pretty quickly in the overall scheme of the economy. I'm not trying to deflect the question, but I think that we really need to look at policies and how long those policies will take to implement and things like that, because markets are priced on corporate earnings going forward over the next 2-3 years. That's what they're looking at in their forecasts, and it's all based on corporate earnings. So I don't think that we have the visibility right now to see where either of a Democratic or Republican win would have that impact. It's hard to see that. For us, politics is mostly noise. It's not actual data points that we consider deeply. What we do look at is long-term policy, and I think that's still, it's still being hammered out. I mean, we do have lower taxes. That's probably good for the economy overall. So that was one positive trend, and that trend right now looks like it's set to continue unless there's some big sea change. Any other question? I think these are really great questions. Asking the tough ones. They're hard to answer. Another question. What's your take on housing prices in 2020? So, housing is, 2019, we saw some softening in the housing market. I think we definitely saw that in the major urban areas, New York, San Francisco. It wasn't much, but it was a mild softening. That might have been, there's probably a couple of effects for that. Certainly the sales volume is going down. Prices are very, very high relative to incomes. So I would not anticipate real estate, at least for like existing homes, let's say, to improve substantially in terms of price. Having said that, though, there were some reports out over the weekend how there's been starting in the fourth quarter, third and fourth quarter, with the decline in rates, there's been a huge refinancing boom. So, meaning people are taking advantage of their equity to do other things. Maybe it's remodeling, maybe it's shoring up finances, et cetera. But that's the positive side of the lower rates is the financing costs. So, but as far as housing itself, we're at pretty fair market values for the stock market. I would say we're very full values for real estate, but the real estate's all about location too. So, in terms of the real estate, there are spots that are still attractively valued and you can still make some money. We got another question. Where do you see the bond market going? Would things like alternative credit funds or life insurance be viable substitutes? Um, yes. Alternative credit funds are those, they're like private credit funds that allow for certain investors to be able to access what they call the private credit markets, where they're not publicly traded bond markets where you have higher yields. The bond market itself still is at, from an earning interest rate perspective, still at extreme lows, which makes it difficult to earn income on fixed investments like bonds. Alternative credit funds potentially could be an alternative for those who qualify. Life insurance, likewise, is an interesting, it's what we say, non-market correlated fixed investment. So whole life insurance is a great asset to have as part of a portfolio. It acts like a bond portfolio, but doesn't have the same kind of volatility. So that can be attractive. Life insurance, however, is a long-term play. So from a cash value perspective, it's not a short-term investment instrument. It's really a long-term instrument that's integral to an estate plan, particularly as it relates to the death benefit. Are there any other questions? Are there any other questions? We've had a few good ones. If not, we will sign off. Everyone have a great day. I hope you enjoyed our presentation, and be on the lookout. In August, I believe, we have our halftime report. So that's where we check in on the state of the markets mid-year. We do this twice a year, and look forward to reaching out to everyone soon and having a meeting with all of you. Thank you.